Welcome everyone to London Business School Wheeler Institute for Business and Development COVID-19 series. This is the third webinar with a focus on the UK economy, and we are very pleased and happy to have with us today my dear colleagues, Professor Paolo Surico, Professor of Economics at the London Business School, and Hélène Rey, Lord Bagri, Professor of Economics at the London Business School. Both Hélène and Paolo have done very important work on issues that we will discuss today. Paolo has been working on corporate finance and household debt with a UK focus. Hélène, one of the leading scholars in international finance, has done very important work on financial regulation, global capital flows, the unique position of the US in the global financial system, and among her various duties, Hélène and Paolo have worked with UK government officials. So today's webinar will focus on UK firms, their capital structure, and the role of financial sector policy. So without further ado, Paolo and Hélène, welcome. Thanks for taking the time and being with us today. Paolo, let's start with you. I know that you have been working a lot on UK firms, their financial position, their capital structure, their assets and liabilities. Why don't you give us, please, an overview of how COVID-19 hit British firms, what were the conditions before, and how the pandemic has affected UK firms?
Thank you very much, Elias. It's a great pleasure to be here. Let me set the scene for what was the capital structure and the anatomy, really, of corporate borrowing in the UK. So whenever we talk about British firms, we emphasize a lot the role of small and medium enterprise. And this is important because they contribute to most of the job creation in this country. Let me start with a striking chart that comes from my own research. What you see on the vertical axis on the right is the size of firms in terms of number of employees. So here I'm really showing you for firms between 0 and 100 employees. We are talking of millions of firms in the UK. What you see on the horizontal axis is the age, number of years since foundation. And what you see as the vertical axis on the left-hand side is leverage, how much they have as debt as a share of asset. There is a lot of emphasis about the size of firms, but what is not really appreciated, that many of the small firms, they have no desire to growth. And therefore, it's not always obvious that small firms are the ones that are more problematic with more financial problems. What we find much more important is to look at the age of firm. Firms which are small tend to be younger and tend to be more highly levered. Another feature, a characteristic of the UK economy, shared with many other actually advanced economies, and not very much appreciated, is that most of corporate debt between small and medium enterprise is really associated with housing debt. So let me give you two statistics coming from a paper of mine and a paper standalone by my co-author, which tell you how much about the total asset that firms have is dependent on residential real estate. And what you can see is that the smaller are the firms, the more they have a share of residential estate, which is as a fraction of total asset, that is much larger than larger firm. And if you go to young high-levered firm, that we are going to see tend to be the more financially constrained in the UK, the difference between young and levered firm and old or levered firms is even much higher. So a lot of the assets, they are in form of residential estate. Also, 75% of small and medium enterprise loans in the UK are secured against property value. Among 40% of loans to small firms are secured against the director home value. Those are firms which do not have much cash flows, they don't have much assets, so they have to rely to the home value of their director to access corporate loans. And also between young firms, 50% of corporate loans are secured against the director home value. Of course, because of this creative capital structure, should not come as a surprise that the more constrained firm in the UK, the young and high level, tend to have access to credit. This is before COVID-19, at a rate, at a price, which was worse than many other firms. So what you see in this chart is this big 4 categorization between young high levered up to old and low levered, and you can see the difference. 2/3 of young high levered firms use personal guaranteed, which 99% of the cases are guaranteed on the director home value, as a securitarization for the corporate loan. This number is only 1/3 for all the low-levered firms. As a consequence of that, they tend to pay 60 basis points more in terms of the price to access that credit. Having so little asset and having to rely on the guaranteed on the director home value, another source of obtaining loans from bank are cash flows. In this chart, again based on my own research, you see what is the ratio of cash flow over asset as a function of the asset at book value held by the universe of private firms in the UK. And what is notable is that those firms, those small firms with a low value of asset, have a level of cash flows which is 3-4 times the value of their asset. In other words, those are firms which A, heavily rely on cash flows to pay their suppliers, to pay their workers, and also they rely on their cash flow to obtain new loan from banks. But as we are going to see, the COVID-19 crisis is very much a crisis of cash flows. So the ones that are going to be hit hardest by the crisis are exactly those small and young enterprises which most rely on cash flow and on house price to be able to access further loan. Just to give you a sense, small firms with the cash flow to asset ratio above 50% account for about 10% of employment among private business. Because private firms account for more than 60% of employment in the UK, this implies that 6% of employment is at risk of losing a job simply as a result of the COVID-19 crisis. Another point to appreciate whenever you go to firms is to appreciate the vast extent of heterogeneity across sector and across capital structure. 10% of UK firms have no cash reserve for less than a month. Another 25% of firms has only cash reserve for 3 months. Only 30% of firms in the UK can survive for more than 6 months without immediate injection of cash flow. And in all this situation, before COVID-19, the main uncertainty facing UK firms was about Brexit. A significant uncertainty. 11% of investment of UK firms has been reduced, according to a survey of CEO of UK firms, simply because of all the time that is taken to organize and arrange to make a contingency plan for Brexit, amounting for a reduction in productivity between 2 and 5% in the 2 years after the referendum. So in all this situation of financial fragility and uncertainty, the COVID-19 hits. And the first thing that is apparent in the data, that this is a largely heterogeneous shock. You're going to see more in this presentation and later with Hélène that there are some sectors which are badly hit by the crisis. Those are retail, those are transportation, those are restaurant. At the same time, however, there are other sectors which are gaining, especially online shopping, revealing that there is some strong form of substitution between retail and online shopping. DIY, home repair, and alcohol and tobacco. Those are all purchase expensive that have really skyrocketed relative to what we have seen of the losing sector. The sectoral contribution is very important across the different sector and dimension of the UK economy. Last week, we have seen from the ONS the release that the first estimate for monthly GDP in April has dropped by 20%. On the left-hand side chart, what you can see is the contribution of each sector to the different, to the fall in GDP. And you can see that manufacturing, retail, hospitality have seen a very, very large contribution. Now, whenever we think about the crisis, I think it's very important to try to figure it out whether this is demand or supply. And there is a very important reason for that, because it guides policy intervention. What we've seen in the data is that consumption has dropped very sharply, very significantly, well before the drop in income. We have seen some recovery in income, possibly driven by the government disbursement through job protection scheme, but we have not seen an equal recovery in consumption, at least not yet. Why this is important? Because this implies that there is a large drop of demand for firm product. So there is a large drop in firm sales, which corresponds to a large drop in firms' cash flow. Clearly, there are sectors which are more affected, and for some of them, the response to the large drop in demand for their product is to reduce their hiring. So what we see is that there are sectors like hospitality or retail which have seen a drop in new hiring as large as 70%. Whereas there has been other sectors, like the one in healthcare, that if anything, actually, they are enjoying an increase because there is an increase in the demand for their services. This is for the new hiring. In terms of the existing hiring, we are seeing many government schemes, 81% of all British business that actually have applied for government protection scheme exactly to protect the existing labor force. Another dimension that is very important to bear in mind is that this has a bare consequences of the heterogeneity in the increase and decline of supply across sector, is that different sector, different products, different goods experience a huge price volatility, with some sector clearly getting a very strong demand for them, and therefore we are seeing also an increase in prices, and other products, goods, which are seeing a strong decline of demand, and they correspond to a decline in their prices. So those are experimental data in this chart provided by the ONS to try to monitor what are the behavior and the fluctuation in online prices. This was a serious challenge for policy about how we are going to measure inflation, how we can target inflation in the face of so much volatility and so much dispersion. Relative prices are going to become more and more important going forward. But of course, one of the largest deterrent for any firms, including the UK, is uncertainty. What you see in this chart is an indicator of what is the percentage of business who saw Brexit as their top 3 source of uncertainty. The series for Brexit has never gone above 55%. Never more than 55% of firms thought of Brexit as a top uncertainty. You go to COVID-19, and these numbers are more in the ballpark of 80%, with clearly a large increase between March and April before stabilizing in a number just below 80%. So if you thought that Brexit uncertainty was bad, with an 11% of drop in investment and a 3 to 5% drop in productivity, COVID-19 uncertainty is an order of magnitude larger. Why this is matter? Because when there is a high uncertainty, there are 2 things we see. A large drop in investment, but also a large drop in new company registering. A large drop in startup. So what we have seen already in the month of April, that there has been an average decline of 26% the highest on record, in the number of new startups, in the number of new businesses that want to register. And again, not surprisingly, there has been a huge heterogeneity in this drop of startup, typically led by sectors like retail, public administration, finance, real estate, and construction. So what is how the future look like? Well, startups, as we mentioned before, are very important because they contribute to the majority of job creation in the economy. So, in a survey conducted by the Bank of England, a very large fraction of firms highlighted employment risk as one of their top priority, as one of their top concern. In fact, there is an expectation that in the year forward, employment might go down, but as much as 10%. We have already seen a drop in sales and investment as large as 40%. The expectation for the UK firms is that there will be some recovery in the sense that the fall is going to be smaller in the next few quarters, but still those numbers are extremely persistent and extremely high. In 1 year time, it's still expected that sales will be 10% lower over what was in the previous year, and investment will be 20% lower. So where does this bring us? Well, we have learned two things. Small and medium enterprises in the UK are very reliant on their direct or home value and their cash flow to run their business, pay supplier and pay workers, but also and more importantly to obtain loans. We have seen one of the first consequences of COVID-19, a large drop in sales, especially for some sectors like retail, transportation and restaurant. Those are the sectors that are more reliant on cash flow. Those are the sectors that are more reliant on the direct or home value to be able to access credit. So not only those small business will be in difficulty of cash flow to run their operation, but there will be more problem, it will be more difficult for them to access credit, which is one of the main reasons triggering the large government intervention in form of loans, in form of cash grant, in form of furlough scheme through the Job Protection Act. There is, however, a very complex question for the government. Under condition 1 and 2, so when you have a drop in cash flow and a drop in the house value against which your corporate debt is secured, not only you are illiquid, but some of those firms that would have been solvent before the crisis might meanwhile could become also insolvent if the drop for their demand turned out to be permanent or at least more prolonged. So what the government should do? Should try to rescue all those firms? Textbook economics and finance will tell you, save those that are illiquid but solvent, but how about if some of those firms now become insolvent? Also, we have documented that there is a very large heterogeneity in product demand and in relative price. Should the winning sector, should the government think of subsidizing the losing sector by acting on the winning sector? Should the government think of some reallocation policy in the labor market to try to shift the excess of labor supply in some sector towards where there is excess of labor demand in other sectors? So many big questions for the government, but many large change we are seeing on the demand and the supply side of UK business. And this is very much from me. Elias, the floor is back to you.
Thank you, Paolo. This was a very interesting overview of patterns of British firms before COVID and how they were affected. Let me ask again that you can pose your questions on the Q&A, and I will pose them in the end to both Paolo and Hélène. We already get some very interesting questions, which I will postpone because I want to turn now to Hélène. Hélène, let me welcome you again to our webinar today. I think Paolo stopped posing some important policy questions, which sectors and which kind of firms the government should assist, for how long, Already we are getting questions about the employment implications of COVID-19 and how government support could assist. So why don't you give us an overview of what the government has been doing, what are the objectives, and what shall we expect?
Thank you very much for including me in this conversation, Elias. So actually my presentation will fit pretty much out just after what Paolo just said. Paolo showed you that the COVID-19 crisis has been a very important shock to the macroeconomy. And certainly if you look, so here you see on figure 1, the UK Composite Purchasing Manager Index survey, you will see that the current shock is actually larger than the 2008 shock, which was created by the great financial crisis. So even though this current shock that we're experiencing is exogenous and did not come from the financial sector, it has attacked the real economy in a very massive way. And of course, it is partly a result of health concerns that we had to shut down the economy in order to for health policies to be effective. So this is to some extent entirely normal that the real economy has come to a standstill. However, the magnitude of a standstill is pretty impressive. And what also Paolo has pointed out, and I'm going to point out as well here because I think it's really important, is that the heterogeneity of the shock across sectors is absolutely massive. So on figure 2, you can see the change in turnover among firms of different sectors due to the COVID-19 shock. And here, if you look at the blue bars, these are the percentage of firms which have purely and simply suspended trading because of the COVID-19 outbreak. And you see that in some sectors, there is a very large proportion of firms which have suspended trading. This is the transport and the arts and entertainment sector. But in a variety of other sectors, if you add up the pink bar and the green bar, these are the sectors for which the turnover has been down by more than 20%, which is already also a very large shock. And you see that this is relatively widespread across the economy, while the gray bars are the sectors for which, or the percentage of firms in the sectors for which the trading has been relatively normal. So you see that there are some sectors for which this is the case, especially ICT, for which the turnover, the firms which report a normal turnover is the majority. But across the economy, this is not the standard case. And finally, the red bars are the sectors for which the turnover has been up. And you see that there are very, very few of those. So the shock is massive and it's very heterogeneous across the whole spectrum of firms and sectors. Now, if we look at financial markets and how the risk premium has changed on UK markets, which is very important, of course, for the financing of firms, what we see here on the left-hand side of this graph on figure 8 is, so if you look at the blue line, this is the equity risk premium, which has been going up in the recent period, but I think much more striking and interesting are the increase in spreads. So these are the other line, the pink line, the yellow line, and the green line, which are all increase in bond spreads of various bonds categories. So the pink line is going to be the investment grade bonds, and the green line is the high yield bonds. The yellow line is the unsecured bonds. So you see that the increase in spreads are really large in the current period. And they go to levels which have been seen in the 2008 crisis, and for some of them also during the euro area crisis around 2012, in some cases exceeding those levels. This reflects a serious tightening of the financial conditions in the UK, which you can see on figure 14 on the right-hand side here. You see that here the index, the more positive index means tighter financial conditions. And you see that these pink bars here, which are the tightening of financial conditions caused by this increase in spreads, risk premia, credit spreads on all kinds of various bonds. These tightenings of conditions have not been offset by either the blue or the green bars, which are the sterling depreciation for the green bars, or a decline in interest rates for the blue bars. So on net, we see an important tightening of financial conditions, which is very important, of course, for the financing of firms in the UK economy. Now, of course, there has been some policies in order to alleviate this problem. And here, there have been a lot of schemes which have been put in place by the government and by the Bank of England in order to bridge this critical situation in which a lot of firms do not have sales, they do not have cash in order to survive, and therefore they need to borrow. That's the only way to make the bridge to hopefully a brighter future. And borrowing has taken off in large part because of support policies. So if you see here the chart 11, which is UK investment grade bond issuance, the 2020 issuance that you see on this graph is largely bigger than the average of the 2016-2019 average. And this is because of the support that has been put in place, in particular by the Bank of England and the COVID corporate credit facility, which have helped companies to go to the market and to raise money in order to have a bridge, to have some bridge financing to survive this very difficult period with a loss of their sales. On the right-hand side, you see the term funding scheme for small and medium-sized enterprises, which has also been put in place recently. And you see that the red bit here, that's the new scheme, there's been a lot of take-up right from the beginning, which is unlike the former comparable scheme that was put in September 2016, where the take-up was slower. But here there has been quite a lot of take-up from the start. Now, these are for the bonds market and for the smaller companies, but in general, UK banks' net lending to corporates has increased massively to 33 billion in March, which is around 30 times the average monthly lending seen in 2019. What is behind that massive increase? Well, definitely the need for funds that we have emphasized, Paolo and I, but also the fact that what is backing these loans are the government guarantees, which are depending on the size of the loans from 100% to lower. Firms which had the relationship with banks have been drawing on their credit lines in order to survive that difficult period. And I think what is worth noting and emphasizing at this point is that so far the banking system has really been able to absorb that very massive financial shock, very massive shock to the economy that we have seen. There has been a stress test performed recently by the Financial Policy Committee, which is the macroprudential authority at the Bank of England, with very stringent scenarios, a peak to trough fall in GDP of about 30%, unemployment peak at 10%, house prices fall by 16%. And the banking system has been, or is being thought to be able to resist to a shock of that magnitude. And so far, we have seen some resiliency, quite some resiliency in banking systems, not only in the UK, but also elsewhere. I think it is fair to say that if there had been a similar pandemic shock which had struck the banking system, not only in the UK again, but in the US or in the European Union, before the financial crisis of 2008, the overall impact of such an incredible shock would have been to probably wipe out quite a lot of the aggregate capital in the system. From that point of view, I think we can say that the change in banking regulation that have been put in place after the 2008 crisis, in particular the Basel III regulations, have been successful by increasing the resiliency of the banking system, by increasing the capital adequacy buffer of banks in general by large amounts. Now, of course, it does not mean that we are out of the woods and that we won't have problems down the road. It doesn't mean that, but it means that at least the resiliency so far has been increased. What is true as well is that because we started from a better, more resilient system, the macroprudential authorities have been able to actually relax some of the macroprudential policies such as decrease of a countercyclical buffer, which is an additional buffer that the banks have to have during good times. And this countercyclical buffer has been decreased by all the macroprudential authorities in Europe. Other regulatory measures have been also temporarily relaxed in order to avoid credit crunches in the very different countries. So for the moment, I think the banking reforms and the active use of macroprudential policy are helping to save the flow of credit to the economy. So these are, I would say, the good news. But of course, this bank lending, massive, this debt issuance, massive, lead to more indebtedness. That's by definition in the economy. And therefore, I think the relevant questions going forward is whether we are going to see a lot of debt overhangs for firms, so over-indebtedness of firms, which is going to lead them not to be able to invest as much as they should, not to be able to hire as much as they should, and also whether down the road we might see risks of non-performing loans on bank balance sheets going up. So these are the two main concerns I think that the current situation and macroeconomic policy would lead to. Now, we are in a situation where we are thinking of exiting lockdown in many different countries. And at the same time, there will still be some physical distancing, and demand uncertainty is very high. As Paolo showed, the various sectors face very different demands for their products. And these two factors will still impact very much economic activity. There will be some gradual withdrawal of guaranteed schemes of the governments, and the gradual withdrawal of the furloughing programs in particular in the UK and elsewhere. And as these programs are being withdrawn, this will lead to bankruptcies of firms and to possibly large increase in unemployment. So at this stage, I think we are seeing quite a complex trade-off between the protection of workers and firms and also the necessary reallocation of factors across sectors. Some sectors will need to contract, other sectors will need to expand, but this reallocation across sectors is costly. And of course, there is a risk of mass unemployment in the process. Following the shock, the heterogeneity in companies is very high and is going to be very high. Some companies, fortunately, and let's hope the majority of them will recover. They will have enough profit to recover the COVID losses and also to pay off their debt. But other companies will be able to make some profit and recover part of the COVID loss. They will be able to pay off some of the debt, but this will be very much at the detriment of investment and hiring. So this could be what I described before as a debt overhang problem. In such case, some of these firms may be like zombie firms. That means that they will be surviving. However, they will not fulfill their growth potential simply because of a debt overhang that they will have to repay. And there is a case for restructuring such firm, for converting part of their debt into equity whenever possible. For other companies, the COVID losses will not be recovered, and debt has made or is making this company not viable. So debt is not sustainable. But these companies would have been viable without the COVID crisis. So here there is a judgment call. Probably one wants to save this company, which can be considered viable in the future. But if we want to save this company, then definitely the debt has to be restructured. And finally, of course, there are some companies which were not viable before the shock, or whose business model has been made totally obsolete because of the COVID crisis, and these companies will fail. So here, the process of coercive destruction and reallocation will have to take place. Now, these companies that I call the zombie companies, which have quite a bit of debt and which are not going to be able to invest. So we have some studies in economics that have looked at such companies in the past. in particular in the context of Japan, where because of the big crisis of the 1990s, part of the economy has been zombified. And there has been also some follow-up studies following the euro area crisis in 2011, 2012. And so here what I show you is from a study of Vera Lasharia and his co-authors, the share of zombie firms in 11 European economies. So that's an average share between 2009 and 2016. And you see a sharp increase in zombie firms from a relatively low level. Zombie firms are defined as firms which are heavily indebted, but that nevertheless receive subsidized credit so they can survive, essentially. Now, does it matter when we have a lot of zombie firms in an economy? Yes, it does. These zombie firms tend to have high leverage. So here on this graph, the zombie firms are the firms which have the green dashed line, and they are compared to a healthy firm, which are the blue lines, and lower quality, but nevertheless non-zombie firm, which are the red line. So the zombie firm are the green dashed line here. And you see that they tend to not to have too much cash on their balance sheet. They tend to have more leverage whenever they can. So the vertical line here is a massive intervention by an important intervention by the European Central Bank, which enabled firms to borrow more at lower rate. So we see an increase in leverage of the zombie firm at that point. But you see that the employment growth and the investment of the zombie firm are the lowest. So you see that this green dashed line for employment growth and investment, they are at the bottom. So that means that really this is not good news for the future potential growth of the economy. And this is why it's important to think about whether there is not too much zombification in the economy. Furthermore, so not only are the zombie firms not investing too much or not hiring too much, but there is a congestion effect from zombie firms, since by skipping some labor and capital, they are maintaining artificially high costs for these factors. That's to the detriment of a healthy firm, toward which these factors could be relocated. So if this is what is to be expected in the economy, one can think of trying to do some debt equity swap in order to decrease the share of zombie firm that can potentially appear after big crisis. So this is now the big, I think, policy trade-off that we are facing. We have to deal with sectoral reallocation versus mass unemployment in a number of countries, including in the UK. And how do we recapitalize viable firms while we let some non-viable firms fail? Saving everyone, of course, is very costly for public finances. And if we think about zombification, may not be desirable either. However, I think we also have to emphasize here, and that's a key point, I think, for the current policy, that we should not think that the private sector is going to be actually do the optimal amount of restructuring. And if we let the economy under laissez-faire, it could be that liquidations and bankruptcies in the economy would be too large. There would be too many of them. So why is that? It's because the social value of a firm may actually substantially exceed its private value. So when we have a massive shock, like the one we are going through, if we have massive layoffs at the same time, this has a lot of negative spillovers, obviously for workers who all have to find a job at the same time. It's a negative externality. There are also demand externalities, which may be very important. Network effects in a fragile and depressed economy are more relevant than usual. And the bankruptcy cost of closing some firms may have major effects on the suppliers and on the customers. So if we let the private sectors by themselves, then maybe probably there will be too many firms being closed down because only the private value of a firm would be considered. So there is this very important tension between creative destruction and sectoral reallocation versus these inefficiencies and massive unemployment and social problems. As a side note, bankruptcy courts also could be overwhelmed when we have a massive shock like the ones we are going through. So here we go. What are the possible policy options and possible policy questions that we have to confront? How do we sort between viable and non-viable firms with this huge uncertainty? Most likely large traded firms and small firms need very different schemes. We have fundamental question: who should do the screening? The banks, investment funds, the government? What type of financial instruments should be used? For large firms, we can use standard instruments like non-voting preferred stocks, for example, if we need to recapitalize them. How about the SMEs? That's a lot harder. How does one value and recapitalize SMEs? So here there are various options that can be discussed. Could, for example, guaranteed loans be changed into ex-post share of profits of those firms? Could these loans be changed into quasi-equity, such as long maturity junior debt? And there are some interesting policy proposals made in particular by Olivier Blanchard and his co-authors regarding some joint debt restructuring by banks and government. But these we need to think very seriously about incentives and the conflict of interest when we think about these issues. And finally, what type of conditionality should be attached to public lending schemes and recapitalization schemes when so much public money is being given to the private sector? So these are very important issues that I think are coming to the conversation right now, and that have not been sorted by any means, and that are going to be, in my view, relatively common to a number of advanced economies in the coming months. So to conclude, I think as public support policies are going to be gradually withdrawn, we're going to see much higher risk of bankruptcies, liquidations, and possibly massive unemployment. The UK companies' debt will have increased a lot, and there's a clear tension between saving companies and also doing some sectoral reallocation. If we choose laissez-faire, there's probably too many bankruptcies and liquidations. And this is because we have very important network effects in a depressed economy that we have to be very careful of. When demand starts going down, this depresses various sectors and there are contagion effects. However, we also should think about possible zombie firms in the economy. And finally, there are some policy implementation issues. If one wants to recapitalize the private sector, what is the best and cost-efficient way of doing it, and under what conditionality? Let me stop here and give back the floor to Elias.
Thank you, Hélène. We have received quite a few questions. Some of them regard labor markets and unemployment, which I think is a primary concern for all of us. There is an issue about expectations, and I see two questions here. One regarding a potential second wave of the pandemic, perhaps in the fall. And then we also have Brexit. So let me start with you, Paolo. First of all, there is a question that Rebecca is asking: how different is the corporate finance and the huge reliance on cash of British firms vis-a-vis, let's say, US or other firms in other countries? So why don't you take this question, and Paolo, why don't you also give us your view about short-term uncertainty regarding to COVID and more medium-term uncertainty regarding Brexit?
Thank you very much. Those are excellent questions. Regarding the international comparison, I can say that two features are shared by many other economies. The first one is the reliance of small and medium enterprise on direct or home value. And the second, the fact that small and medium enterprise tend to be higher on cash flows, and in particular on cash holding, exactly because of a precautionary motive of wartime. But of course, because they have much smaller asset, they also tend to have a cash flow to asset ratio, which is higher than larger firms. So those two patterns, which I have documented for the UK together with my co-author, actually are featured which are prominent also in many other advanced economies. Regarding
No, please, I didn't mean to stop you.
Regarding the uncertainty, I think that there is here a massive uncertainty, not only for firm, but also for government. And I tell you at the moment, what in my mind is the biggest uncertainty for everybody, which is whether the government should put its money, whether the government should give its support. And clearly what the government is doing is extending a blanket to all UK firms, and in particular to all UK workers. This makes sense as a contingency immediate plan, but all those schemes will come to an end. Those schemes do not solve the problem, do not tackle the causes of the problem, they only address the consequences. If we don't use that time to try to reallocate, I mean, the word sectoral allocation, it came up several times in mine and Hélène presentation, and I think is really going to be the key dimension for policy. If the policy do not generate those incentives to move workers where there is excess labor demand from where there is excess labor supply, I think that by the end of October, when the furlough scheme will stop, I think we will end up with the same situation we would have seen if the government did not intervene at all. How the government could do that, I think it should be much more proactive on the demand side. All this cash flow short circuit for firms in the UK and in Europe comes from the large drop in demand, from the large drop in turnover, which trigger all this government intervention, which trigger this drop of cash flow that risks the bankruptcies of so many firms. So the big question for policy are sectoral reallocation, and are we treating the consequences rather than the causes of the crisis?
Thank you, Paolo. So Hélène, let me also pose a question to you regarding uncertainty. We get a couple of questions about Brexit, and I'd like to, we don't want this to be about Brexit, but clearly there is perhaps an interactive effect of COVID-19 related uncertainty and Brexit. And second, what would be, so many of our friends are asking questions about whether the high levels of debt will constrain monetary policy in the future, because the Bank of England, for example, will not be able to raise rates just because this will have effect on borrowers, and I would say also more generally on policy.
Thank you very much. So it's also, these are excellent questions. So let me start by maybe the second one. So as I pointed out, one of the legacy of the COVID crisis is going to be a massive increase in indebtedness of firms and of governments as well, but definitely of firms. And the ability that the various firms will have to repay this debt is going to be also highly heterogeneous. So there are firms for which demand can be expected to rebound quickly. There are firms for which demand will not rebound quickly at all, and we don't actually know at this point whether and when demand will rebound. So we can think about, of course, all the sectors which have to do with tourism, with transportation, and more generally face-to-face interaction with customers. So there's great uncertainty regarding the speed of a recovery there, and there should be uncertainty because, of course, it has to be conditioned on health outcomes and whether there is a second wave or not, whether we have a vaccine or not, and when we'll have it. So we cannot say anything for sure. But that means that the ability to repay debt is, in my view, a major issue going forward for a significant number of sectors of the economy. This is why, because it can be a very unhealthy situation, what I was suggesting is that we should be considering or starting to consider policies which start to switch from debt to equity or try to implement some recapitalization of some firms, so debt equity swaps. This is, this has been done already in the context of large companies, airlines, for example, where there has been some equity stake being taken in various countries. But that's very difficult or much more difficult to do for small and medium enterprises. So the valuation of these companies is hard to do, and where we are not, or the government is not used to do that for small and medium enterprises. So this is where I think one needs a lot of clever policy design. And I think that would be important, not only for indeed monetary policy in the future. Though here I expect that the real rate of interest is going to stay quite low for a long time. So I don't expect that we are going to see a constraint binding anytime soon. So that would not be my first concern. But I think it's going to be very important for the future potential growth of the UK economy, since indebted firms do not invest and do not hire very much. And the probability of default is always there, hanging upon their head. So this is why I insist that these policies of potential recapitalization should be thought about now with a little bit, with a lot of granular data and a lot more detail. So that's my first answer. The second question is about, of course, the interaction of this COVID shock and the Brexit shock. And there, it is of great concern to me. Both shocks have the potential for long-lasting effects. So the so-called scarring of the economy. So in the COVID shock, we can have some scarring if we don't manage the reallocation across sectors well. Unemployment goes up, and this has human capital consequences for the long run. Also, bankruptcy of firms. If we let too many bankruptcies happen, as I also try to point out in my presentation, maybe the private sector is going to liquidate too many firms, too many assets, which will have some effects on networks and amplification effects on the economy, which we also have to be very worried about. But of course, the Brexit shock is also a shock with potentially very long-lasting consequences. We are still not quite sure, I think, about what kind of trading relations the UK economy will have. And therefore, the size of a shock which will hit the different sectors it may not be the same sectors which are hit by the Brexit shock in the same amount as the one which has been hit by COVID. We don't know that yet, but I think it would be actually quite interesting to come up with a granular study of the Brexit economy with an output matrix of the various interactions across sectors, and to see to which extent there's going to be an amplification across these two shocks, or to which extent they hit sectors which are different from one another. It's hard to see from aggregate data, but if we think about transportation sector, if we think about the tourism sector, we may have the potential here for sectors which are hit 2 times on the head.
Excellent. So we're running out of time. So let me just ask a one-on-one question to each of you. Paolo, given also your previous work on forecasting and given your work using real-time data, some friends are asking, what about a second wave in the fall? What can government do then? It seems that they are going already stretching themselves.
So this is an excellent question. And the true answer here is that nobody knows. But we have a little bit in which of science and data can guide a little bit. As I said before, and then we have stressed in our lectures we have prepared with Andrea Galeotti and all the rest of the Econ team, including you, Elias, and Hélène, and Lucrezia, and Andrew. What we have emphasized is that all these intergovernment intervention, both in terms of lockdown measures, social distancing, but also support with the furlough scheme, are all measured by times. The economy is now in an induced coma, which is important to buy time, but what is crucial now is what you do with that time. If there is not much happening on testing, so we have here 2 forms of testing. Testing the health care of UK citizens, but also testing the consumption and investment of UK households and UK firms. There is the potential for the second wave to be potentially larger than the first wave in a cumulative way. This one has been a large shock, which have taken us unprepared, and therefore has been in a short period of time a very large drop in demand, which has triggered, in my opinion, all the effect that we've seen. Now we know there will be a second wave coming, so we are going to be for several months of social distancing, of fear and uncertainty, which will contract, that will disincentivize consumption and demand. I hope the government will do much more on the demand side. What I see now as the bottleneck is the top 25% of people at the top of income distribution contributing to 46% of the drop in aggregate demand. This is a first order magnitude. If you don't manage to revert and to channel all these savings back into the economy, there is no help that you provide of firms that can be possibly offset that. So the government should really focus on stimulating demand by discouraging saving at the top of the income distribution, at the same time of reallocating firms there where there is more demand following the COVID-19 shock. If this happens, I will be much more optimistic on the economic impact of a possible second wave.
Thanks. Hélène, last two questions, but please with just one very brief answer. Do you see inflation or deflation in the years to come? Do you foresee a financial crisis because banks will be stuck with a lot of non-performing loans?
So on inflation, clearly there's both an inflationary shock there because of the effect on the supply side and the effect of some scarcity of production and an increasing cost, and also a demand shock, which is very massive. And I think the demand shock is the one that is actually quantitatively dominating in the data. So I expect, I think like most macroeconomists, that this is a deflationary shock. And I expect also that the natural real rate of interest is going to be very low, possibly going even lower than it was before the COVID shock. So I expect we are going to be in disinflationary mode for the coming years. We obviously have to monitor very closely the very fast movement in some relative prices, and in particular whether that could have some effect on inflationary expectations. So it's a guarded answer, but I expect it to be mostly deflationary. On the financial crisis side, I think what—
I need a yes or a no.
So I don't expect a financial crisis as my main scenario. Obviously, there are qualifications to that. First of all, we need to be very careful about non-performing loans of the banking system, and we might need to take some policy actions there for advanced economies. And then emerging markets are under very serious pressure. And so there my answer does not apply, unfortunately, for some emerging markets.
Thank you, Hélène, and thank you, Paolo, and thank you all for joining us in this third webinar of LBS Wheeler Institute for Business and Development COVID-19 series. Let me remind our viewers that on Friday we will be joined by Andrea Galeotti, our great colleague at London Business School of Economics, and Flavio Tockford, our former PhD student currently at the University of Cambridge, discussing about behavioral responses testing and how the UK can design a successful exodus and gradual exit from the pandemic. Then on Monday, we will have a session focusing on the NHS with Sir Andrew Lickerman, a professor of accounting at London Business School and our great former dean, Rafaela Sadun joining us from Harvard Business School, and Nico Sava from the operations research of LBS, discussing about NHS. And I'm very happy also to announce that on July 1st, we will be honored to have with us Tony Wheeler, our great benefactor, founder of Lonely Planet, discussing not about economics, but about the future of travel. You can find all the material at the London Business School Wheeler Institute for Business and Development website. Please feel free to email us suggestions or comments. You can find a lot of material from our previous webinars, as well as transcripts and the slides. Plus, the Wheeler Institute has also launched mini interviews with practitioners and researchers and policymakers about various COVID-19 related aspects. Thank you very much for being with us today.